Okay, let's unpack this. Have you ever been scrolling through, financial news, seeing all the headlines about market swings, investment opportunities, and just wondered, should I be trading the market or should I be investing in it?
It's a super common question.
Yeah, and it feels like a riddle sometimes, right? The lines can get really blurry, and honestly, a lot of us end up feeling kind of lost about how to actually, grow our wealth effectively.
Easy to get confused.
So today, we're going to really dig into the world of finance. We're going to untangle these two approaches, trading and investing. They seem similar on the surface, but they're really different at their core.
Fundamentally different, yeah.
Our mission here is pretty clear. Cut through the noise, lay out the distinct strategies, flag some of the surprising pitfalls, and ultimately help you figure out which path really clicks with your own financial journey and, your personality too.
Yeah, temperament's a big part of it.
Definitely. We've pulled together some fascinating stuff for this. There's this great YouTube debate between a trader and a long-term investor, plus some really solid articles from financial experts.
Good sources.
Yeah, should give us a comprehensive view that's hopefully engaging and practical. Get ready for maybe a few aha moments as we explore these two powerful financial philosophies.
That's good.
All right, so first things first. Let's nail down the absolute core difference. What really separates investing from trading? Like, what's the fundamental dividing line here?
Well, what's really interesting is that, both are trying to make money from the markets, obviously.
Right, that's the goal.
But the key difference, it really just boils down to one crucial thing. Time.
Time.
Yeah, time. You often hear it phrased as time in the market versus timing the market. And honestly, that distinction, it shapes absolutely everything else.
Okay, so time in the market. That's the investor's world. What's the thinking there? Is it just being patient or is it something deeper? Like believing in a company long term, even when things get rocky?
It's definitely about conviction and a strong belief in compounding. Investing typically means buying assets, stocks, bonds, whatever, aiming for a long-term return.
Years, you mean?
Yeah, years, often decades even. It's about building a portfolio gradually, focusing on that long-term growth. The classic buy and hold strategy. You're trying to build serious wealth, not just scalp quick profits from, daily noise.
Gotcha. And then the flip side is timing the market. That's the trader's game, right?
Exactly. Trading is all about trying to capitalize on short-term price swings.
Okay.
So buying and selling securities within much, much smaller time frames. It could be seconds, minutes, weeks, maybe months, but rarely longer. It's definitely more speculative, requires active management, and focuses on profiting from market volatility.
So they like volatility.
Oh yeah, traders often thrive on it. Whereas investors are looking for enduring value, traders are looking for those quick opportunities presented by price movement.
And just to clarify, it's not really about what you're buying or selling, is it? Like stocks, ETFs, those exchange-traded funds, got commodities, crypto, bonds. It's all fair game for both approaches.
That's a really crucial point.
Yeah.
The asset itself doesn't define you as an investor or a trader. It's all about the strategy and the time horizon you bring to it.
Makes sense. These differences, I think they really pop when you look at actual people's stories. We heard from two pros in our sources, a trader named Sun and an investor, CK Chiang. Their journeys really highlight these different ways of thinking. What really stands out from Sun's story, especially for someone maybe thinking about trading?
Sun's story is pretty compelling, actually. He apparently started trading almost out of necessity.
Oh, really?
Yeah, about 20 years back, he started with pretty limited capital, something like 200,000 baht, which is what, maybe $5,000–6,000 US dollars?
Okay, not a huge amount to start.
Right. And he felt that to grow that quickly, he just couldn't afford to let his money sit in one stock for ages. Interestingly, he actually began as a value investor.
Huh.
Doubled his money on Shincorp, a big Thai telecom company, but then he deliberately shifted to trading.
So he wasn't just chasing random tips, he was actively moving his money around.
Exactly. Constantly seeking top gainers, quickly rotating capital. And he talked about relying heavily on technical analysis. For him, that was a direct reflection of real-time supply and demand.
Okay.
He was pretty skeptical of financial statements from smaller companies, actually. Said they could be manipulated. He even mentioned the Stark fraud, that recent big financial scandal in Thailand, as an example of why fundamental analysis alone might not cut it in some markets.
Wow. Okay, so he saw technicals as more trustworthy.
In certain situations, yeah. And that's a key thing for traders like Sun. He believes that really diligent traders, especially ones who can spot what he called unfair advantage situations, think market reversals during weird times, like that quick recovery after the COVID crash. They can potentially get much higher returns. For him, volatility isn't scary. He called it a trader's heaven, opportunity.
It's a totally different mindset, isn't it? And then you've got CK Chiang. His journey started with trading oil futures, but he said it was exhausting, didn't make money, even lost a bit. What made him switch so drastically?
Yeah, CK's experience really highlights the psychological grind of active trading.
Yeah.
It just wore him out.
I can imagine.
So he switched to investing.
Yeah.
And his approach was interesting. He focused on companies whose products he actually used and, loved, like Facebook, Amazon, Google, Apple, the big names.
The Peter Lynch philosophy, buy what you know.
Kinda, yeah.
Yeah.
And he had this famous story buying Amazon shares for under $100, then selling them way later for over $3,000 before the split.
Whoa.
Yeah, it just screams power of long-term holding, right? His whole strategy was basically consistently investing his part-time earnings, just letting time do the work.
So CK is all about time in the market. He specifically said he would have missed those huge gains if he'd been jumping in and out trading those stocks. What was his secret sauce beyond just buying good companies?
He had this great line, the true profit is learning.
I like that.
Yeah. He made a commitment to constantly track earnings reports, global news, politics, even stuff like oil prices, just to deeply understand companies like Apple and Tesla.
So real deep dive.
Totally. He noticed Tesla's stock once jumped 22% after beating profit expectations. Even though their revenue forecast was meh, that told him, okay, right now the market cares more about profit than growth for this stock. It's that kind of continuous learning.
That's a great point about context, but it makes me wonder for you listening, how do these different mindsets translate into the actual tools and techniques you'd use day to day?
Okay, yeah, good question. For investors, the main tool is fundamental analysis.
Right.
This means really digging into a company's financial health, its performance, its potential for future growth. You're looking at balance sheets, income statements, cash flow, revenue, profit margins, all that stuff. And key metrics like the PE ratio, price to earnings, which kind of helps you gauge if a stock's expensive or cheap compared to its profits.
So you're trying to figure out what the business is really worth.
Exactly, the intrinsic value. If we were looking at a fictional Weiwei Choose corporation, you'd be deep in their financial reports, not just staring at the stock price ticker.
Okay. And traders, they're playing a different game entirely, tool-wise.
Completely different toolbox. Traders live and breathe technical analysis.
Charts and squiggly lines.
Pretty much. They're studying chart patterns, things like candlestick charts, which are actually pretty cool. They visually show supply and demand battles. And technical indicators. You hear names like moving averages, the RSI, that's relative strength index, which can signal if a stock is overbought or oversold.
Okay, hinting a reversal might be coming.
Potentially, yeah. And MACD moving average convergence, divergence that tracks momentum. They're basically looking for signals in the price and volume data, trying to predict where the price might go next based on history.
So a trader might buy at $10, see it pop to $13, sell, then maybe buy back at $11 if the chart looks like it's going to go up again.
That's the idea. It's all about reading the market's immediate pulse.
And this must mean the risk profiles are way different too.
Oh, absolutely. Trading is inherently more speculative. Traders often use leverage, basically borrowing money to make bigger bets.
Okay, amplifying gains, but also losses.
Exactly. It ramps up the risk significantly. Investors, they face risk too, obviously. Markets go down, but they're generally more comfortable riding out those drawdowns. If their fundamental analysis still says the company is solid long-term, they might even see dips as buying opportunities.
Right, buy low. And traders have tools to manage that immediate risk, like stop losses.
Yeah, the stop loss order is crucial for traders. It automatically sells your position if the price drops to a certain level you've set.
So buy at $10, set a stop at $8, you limit your downside.
Precisely. Protects capital. But, like you hinted, there's the flip side. You might set your stop too tight, sell at $13, and then watch the stock zoom up to $17. Missed profits.
The pain of selling too early. Sounds like a constant balancing act.
It absolutely is. A constant dance between protecting what you have and trying to grab gains. And like they said, traders thrive on volatility. Those choppy markets are where they see opportunity. Sideways markets, where prices just drift in a narrow range, not usually their favorite place.
Yeah, not much action there.
Whereas investors, they're generally more indifferent to the daily ups and downs. They care about the long-term trend of the company's value. Plus, the psychological side. Trading demands constant monitoring, quick decisions. It can feel like a high-stress, full-time job.
Right.
Investing, once you've done your homework, can be much more relaxed. Kind of set it and forget it, or at least check in less frequently.
Okay, so very different strategies, very different tools. It makes sense they have different dangers too. Let's talk pitfalls. There's a classic trading trap called the bear trap. What is that exactly, and why does it trip traders up so often?
The bear trap. Yeah, it's a really deceptive market move that catches traders off guard, especially those who might be a bit impatient or jump the gun.
How does it work?
So the price of something, a stock, whatever, look like it's starting a downtrend. It breaks below a key support level.
A price floor where buyers usually step in.
Exactly. So traders see this break and think, okay, it's going lower. They initiate short positions, borrowing shares to sell, planning to buy them back cheaper later for a profit.
They're betting on the price falling further.
Right, but then, boom, the price suddenly reverses, shoots back up, and breaks back above that support level. the short sellers are trapped.
Ouch. Because now they have to buy back the shares at a higher price to close their position.
Precisely. Leading to potentially big losses, especially if they panic and rush to cover. That whole GameStop short squeeze back in January 2021, that was like a massive headline-grabbing example of short sellers getting trapped.
Wow. So how do traders even attempt to avoid falling into these? It sounds incredibly tricky.
It is tricky. Experienced traders look for confirmations. They don't just jump short because the support level breaks. They look for maybe a quick reversal after the break, check if the trading volume is unusually high or low, use those technical indicators like the RSI to see if it's deeply oversold.
Suggesting maybe the selling is overdone.
Yeah, or they look for specific candlestick patterns that might signal a reversal is coming. It's about layering signals, not just relying on one thing. Vigilance is key.
But what are the common mistakes that lead people right into the trap?
Oh, plenty. Like we said, jumping in short based only on that support break without waiting for any confirmation, or completely ignoring the bigger market picture or major news event.
Tunnel vision.
Yeah. And crucially, failing to use a stop loss order on their short position, or chasing the market getting in way too late after the reversal has already started. But honestly, a lot of it comes down to psychology.
Back to the mindset. How much is just market mechanics versus our own brains kind of working against us?
It's huge.
Yeah.
Bear traps aren't just lines on a chart. They're psychological traps too. They prey on things like herd mentality, everyone else is selling, so I should too.
Right, fear of missing out, but in reverse.
Exactly. Or loss aversion kicks in. The fear of loss makes people bail out of potentially good trades too early, or maybe hold on to losing shorts too long, hoping they'll turn around. Then there's confirmation bias.
Only seeing what you want to see.
Yep, only looking for info that confirms your belief that the price should be going down. And recency bias, giving too much weight to what just happened. The key defense. Recognizing these biases in yourself. Actively look for information that challenges your view, think in probabilities, not certainties, and always zoom out to see the longer-term trends.
That makes sense. Now, you know that famous, maybe infamous Warren Buffett quote comparing active traders to people having one-night stands?
Yeah, I know the one.
It brings up that classic debate. Is trading just a fancy form of gambling? That's how a lot of people see it.
It's a really common perception, and it's worth clarifying for everyone listening. There's a key difference. The risk in gambling, like at a casino, is specifically created for entertainment. The house edge means there's a negative expected return built right in.
The odds are designed against you long-term.
Right. The risk in trading, though, is inherent in just, well, economic activity. Markets move, prices fluctuate. And actually, many short-term trading strategies can make markets more efficient.
How so?
Well, traders who spot mispriced assets, maybe a bond that's trading too cheap compared to its underlying value, they step in and buy it. That buying pressure pushes the price closer to where it should be, closer to its fair value. So in a way, they help ensure everyone gets a fair price. It's a productive kind of risk-taking, not just rolling the dice.
Okay, that's a good distinction. But trading still has some pretty significant downsides, doesn't it? Beyond just the stress and the risk of traps. What about hidden costs?
Absolutely. Transaction costs are a big one, especially for very active traders. Even with commission-free brokers, there's almost always the spread.
That little difference between the buy price and the sell price.
Exactly, the bid-ask spread.
Yeah.
If you're turning over your portfolio really frequently, maybe even daily, those tiny spreads can add up massively. We're talking potentially 10% or even more of your annual returns just eaten up by transaction costs. It seriously erodes profits.
Wow, 10% is huge. And taxes must be different too.
Oh yeah, taxes are another major factor.
Yeah.
Generally, short-term capital gains profits on assets held for less than a year, which is typical for traders, are taxed at your ordinary income tax rate, which is usually higher than the rate for long-term capital gains.
Which investors benefit from.
Right. Investors holding for over a year often pay a lower tax rate. Plus, they can defer paying any tax until they actually sell, potentially for decades. They can even borrow against their portfolio sometimes for living expenses without triggering a taxable sale.
That deferral advantage. Maybe that's part of Buffett's never sell mantra.
It's very likely a key part of it, yeah. Tax efficiency is huge for long-term wealth building. And finally, let's be real, trading is incredibly time-consuming. For many successful traders, it's a full-time, almost obsessive pursuit. Investing, on the other hand, can realistically be done alongside a full-time job, maybe just requiring a few hours a year for review and rebalancing once you're set up.
Okay, so we've really mapped out the differences, the core ideas, the stories, the tools, the traps, the costs. Now, for you listening, the big question, which path should you choose? It feels pretty clear there's no single better way, right? It's all about what's right for you.
That's absolutely the core message. Both investing and trading can lead to success. But the key, the absolute key, is aligning your choice with your financial goals, your personal tolerance for risk, and crucially, the amount of time and effort you're genuinely willing and able to commit.
So thinking about the investor path, CK Chiang's advice seems spot on. Time is your best asset. It's about leveraging that power of compounding. Choosing companies maybe whose products you use. You understand. You're actually excited about where they're going. Not just blindly following PE ratios, but thinking about that future potential. And I loved that other point he made. Buy good companies during bad times.
Yeah, that's classic value investing wisdom.
Like maybe buying Facebook when everyone was freaking out about the Meta investment, or Netflix when its stock took that big dip. Those moments of peak fear are often the investor's best friend, aren't they?
They absolutely can be if you've done your homework and have conviction. Now, for the trader path, Sun's wisdom really centered on extreme focus, discipline, and endurance.
Not for the faint of heart.
Definitely not. Always use stop losses. Always practice robust risk management. Never over-leverage your positions. And crucially, know when to just step aside. Know when to dodge and stay out of the market altogether.
Wait for the right moment.
Exactly. He compared it to a pro gambler in a casino. They don't play every single hand. They wait patiently for a situation where they have a clear angle, a distinct edge, before they put their money down. It's about calculated precision, not just constant activity.
That makes a lot of sense. And maybe the most important warning we heard from the sources was this. Don't try to be both an investor and a trader at the same time. What's the danger there?
Oh, that's a huge one. It speaks to the danger of style drift, especially when things go wrong. Like, you make a trade, it starts losing money, and instead of cutting your losses according to your trading plan, you suddenly decide, oh, well, actually, I'll just hold this long term. It's an investment now.
Rationalizing the loss.
Exactly. It's usually driven by fear or ego, refusing to admit a mistake. Mixing strategies like that without clear rules and discipline is often a recipe for disaster. You end up with the worst of both worlds.
Stick to your lane, basically.
Or at least have very clear rules for when you're wearing your investor hat versus your trader hat, if you do decide to try both in separate accounts or strategies. But ultimately, whether you lean towards the patient growth of investing or the disciplined agility of trading, the single most critical thing, the foundation for everything, is continuous learning.
Yeah, that came through loud and clear.
Without enough knowledge, without self-awareness about your own biases and risk tolerance, either approach can just turn into gambling pretty quickly.
Yeah.
And that's definitely not the path to sustainable wealth. It has to be about informed decisions, always.
Wow, okay. That was a really comprehensive dive into trading versus investing. We've seen how things like time horizon, the analysis methods, risk levels, market psychology, even those hidden costs, they really set these two paths apart.
Big differences.
And it really hammers home that point. There's no universal best. It's about deeply understanding your own financial goals, your personality, your tolerance for stress, really.
Knowing yourself is key.
So as you're reflecting on all this, think about which side of your financial personality you want to lean into. Is it the patient, long view growth of the investor? Or is it the disciplined, quick action approach of the trader? Maybe it's even about learning to use both toolkits, but like you said, with really clear boundaries and knowing exactly when and why you're using each one.
Building a philosophy that fits you.
Exactly, building a robust financial approach that is uniquely yours.
Which leads to, I think, maybe the most important question for you to think about after this. How are you going to commit to that continuous learning? How will you make sure that every financial decision you make moving forward is really rooted in knowledge, in self-awareness, and a clear understanding of your chosen path? And not just based on hope or worse, fear.